Mike leans toward the camera, grinning, and says, imagine a billionaire calmly telling you, just buy index funds. It sounds suspiciously simple, like financial enlightenment squeezed into one sentence, cheaper than any overpriced online investing course. But here's the twist. Those same billionaires rarely follow that index fund advice with their own serious, real money. If you could peek inside their portfolios, you would not see lonely little shares of VTI, VO, or SPY. So if index funds are supposedly the smartest, safest way to invest, why don't the ultra-rich just load up? The answer is brutal. Regular people invest hoping to get rich. Rich people invest desperately to avoid becoming poor. When you are broke, the game is about climbing up. When you are rich, it becomes avoiding catastrophic falls. I like to say, when you have nothing, you fear missing out. When you have everything, you fear losing everything. If the stock market crashes 40%, you complain, maybe grab overtime shifts, and sadly downgrade one beloved streaming subscription. When a billionaire loses 40%, they sell an Aspen house, delay the yacht refit, and might even fly commercial. For you, that scenario is a brutal year. For them, it is an existential crisis with reporters circling like vultures. So billionaires are not chasing maximum growth. They are chasing maximum survivability, trying to stop their empire evaporating overnight. They do not wake thinking, how can I beat the market? They think, how can I avoid exploding financially? And that tiny shift in mindset completely changes their toolkit. Safety, stability, and liquidity look sexier than speculative returns. Now here is their problem with index funds. They are concentrated systematic risk hiding behind a diversified marketing label. When you buy the whole market, you also quietly buy every possible way the system can punch you in daylight. If the economy tanks, your index fund tanks. If banks panic, your index fund panics, dragging your emotions underwater. Systematic risk is basically when the entire party catches fire, not just one drunk guy mishandling fireworks near the curtains. Billionaires avoid that kind of risk the way you avoid your ex at Whole Foods, eye contact, emergency teleportation mode. On top of that, their companies already float inside the stock market, so their net worth bathes in systematic risk. Doubling down by throwing billions into broad index funds would be like betting your rent and grocery money on roulette. That is why the ultra-rich play what I call weird billionaire monopoly, a game with stranger, more complicated properties. They buy hedge funds, private equity, private credit, boring real estate, farmland, royalties, even infrastructure deals nobody brags about online. If an investment sounds boring at dinner, some billionaire is probably collecting steady 6% from it every year. They are not romancing excitement. They are marrying reliability because boredom is beautiful when you already have money than hobbies. Think of their portfolio like a zoo of uncorrelated creatures, each asset class behaving differently when economic weather turns ugly. When stocks crash, long bonds rally. When bonds bleed, maybe gold shines. When gold crashes, farmland grows overpriced almonds. That is the whole game, uncorrelated returns, making sure something is always standing when the rest of the world wobbles. This is why you see billionaires owning sports teams, art collections, farmland, toll roads, data centers, even random media rights. It is not because they adore baseball or abstract art. It is because hot dogs sell whether NASDAQ explodes or not. For them, investing is not a Marvel movie full of explosions. It is a boring insurance policy outliving their descendants. Meanwhile, you and I are in the stage where volatility is painful but necessary, like soreness, building stronger financial muscles. If you are early in your journey, you need concentrated bets or your portfolio will crawl like a sleepy turtle. That is why advice from billionaires can be dangerous. Like marathon runners giving recovery tips to someone learning walking. They say stay diversified, stay calm, think long-term, which sounds wise but ignores you are still escaping financial gravity. Virtue. Concentration builds wealth because focused energy moves mountains. Diversification preserves wealth because scattered defenses stop disasters from wiping you out. Most people copy diversification way too early, then wonder why their portfolio feels safe yet never seems to meaningfully grow. Mike looks straight into the lens and says, please do not copy the defensive strategy of someone who won championships. When you listen to billionaire interviews, remember they are speaking from the mountaintop while you are arguing with hiking boots. They fear losing altitude. You fear never reaching altitude. Two totally different problems hiding beneath identical sounding investment advice. So step one is knowing which game you are playing, offense building wealth or defense preserving what you already built. If you are playing offense, you want educated concentration, strong bets you understand deeply, not 50 random tickers everywhere. If you are playing defense, you want resilient diversification, boring assets sprinkled across markets, credit, hard assets, and private opportunities. The tragedy is that social media collapses these stages. So everyone copies highlight reels without understanding where the star stands. People hear Warren Buffett praise index funds and forget he also owns entire companies outright, like they were cheap Pokemon. Context turns advice into bad execution, and the market punishes bad execution without stopping to explain what you misunderstood. So I am not telling you index funds are stupid. I am telling you they are a tool, not religion. If you are overwhelmed, confused, emotional, index funds can absolutely save you from detonating your future with impulsive casino behavior. But if you eventually reach serious wealth, you will discover their limits, the way billionaires quietly discovered them decades earlier. Mike smiles and shrugs. One day you might graduate from offense into defense mode, but you are probably not there. Mike leans back, laughs softly, and says, billionaires invest like paranoid squirrels guarding acorns, not like gamblers chasing jackpots. They build walls of diversification because sleep is more profitable than bragging rights on another risky tech bet. Meanwhile, average investors chase dopamine from green numbers and call it progress, confusing motion with direction every single year. Billionaires mastered the art of boredom, and boredom, my friend, compounds faster than any adrenaline-based portfolio strategy. So, when they preach index funds, they are preaching peace of mind, not the formula for your financial breakthrough moment. Remember, they already own the economy through companies, land, and influence. You are still renting your seat at the table. The same rulebook does not apply when you are the one printing the rulebook for everyone else playing the game. That is why you must translate billionaire advice through your own stage, goals, risk tolerance, and emotional stability levels. When you still climb the financial mountain, volatility is your friend, testing your grip and sharpening your discipline for altitude. When you reach the summit, volatility becomes your enemy, threatening to throw you off with one reckless gust of wind. Billionaires understand this deeply. They already fell once or watched others fall hard enough to never underestimate gravity again. So they hoard safe yields like dragons hoard gold, boring treasures that quietly keep them untouchable through economic storms. Hedge funds, art, farmland, data centers, even vineyards that lose money but buy priceless tax advantages and legacy prestige. It looks random, but every piece is part of a defensive architecture designed to survive whatever chaos tomorrow invents. Mike smirks. If you think that sounds boring, congratulations. You are finally starting to think like a millionaire. Because excitement is what Wall Street sells you, safety is what Wall Street quietly sells to the people who own it. The rich do not crave thrill. They crave predictability, because when your life is unpredictable, stability feels like luxury. I once met a guy worth 8 figures who said, I miss being excited about earnings season. Now I just want silence. That silence is expensive. It costs diversification, liquidity, patience, and sometimes swallowing your ego for the sake of peace. And yet average investors still dream of excitement because nobody uploads YouTube videos titled, How I Bored My Way Rich. If they did, I promise you it would get fewer clicks, but far more millionaires quietly nodding along backstage. Billionaires' secret weapon is discipline so dull it feels robotic, but that dullness keeps them rich across generations. They invest through trust structures, private deals, and cash flow streams that survive headlines, elections, and your next crypto panic. That is the real definition of freedom, when your money keeps working even when you are asleep, retired, or canceled online. Mike leans in again, voice softer now. Remember, concentration builds wealth. Diversification preserves it. That is not theory, it is physics. The universe rewards energy focused on creation and punishes mass scattered without purpose. Money obeys the same gravitational law. You concentrate when building momentum. You diversify when defending stability. Confusing those phases kills both growth and protection. If you mix them up, you end up with nothing. Too safe to grow, too risky to sleep peacefully at night. So step back and ask, Are you building or defending, climbing or camping, chasing returns or guarding freedom? Because every wrong answer adds years to your journey and takes decades off your eventual peace of mind. Mike chuckles. Look, I am not saying index funds are bad. They are just not sacred scripture for everyone. They are a fantastic tool for beginners, a terrible crutch for those who outgrew them but never updated strategy. And billionaires, they updated early, quietly shifting from offense to defense while still sounding relatable on CNBC interviews. They are not hypocrites, they are survivors pretending to play the same game while protecting a completely different scoreboard. That is why copying the rich word for word is like borrowing Michael Jordan's shoes and expecting to dunk tomorrow. Timonim. Technically possible, practically delusional, but hey, at least you look stylish missing the rim spectacularly in front of everyone. So instead of copying their portfolio, copy their awareness, their risk control, their long-term patience for boring consistency. The difference between wealth and ruin is not intelligence. It is emotional endurance during chaos when everyone else panics first. Mike points to the camera. Calm investors win because they understand wealth is built in boredom and destroyed in excitement. That is why I always say investing is 90% psychology, 10% math, and 100% patience. The market pays you for surviving boredom longer than the next person chasing shiny distractions disguised as innovation. So build focus, build resilience, and yes, laugh at volatility instead of worshiping it like a financial deity of chaos. And if you ever get confused, remember offense builds wealth. Defense keeps you alive long enough to enjoy it. Billionaires already won. They are just running out the clock, passing time safely until the final whistle blows. You, however, are still scoring, still building, still learning. So stop copying their playbook and write your own strategy. Mike grins. If you found this helpful, congratulations. You just survived 10 minutes of financial truth wrapped in sarcasm. That means your attention span might already be worth more than half the meme coins launched this week combined. Now do yourself a favor, like this video, subscribe, and tell me in comments which game you are playing today. Are you climbing, defending, or pretending? Whatever it is, at least now you understand why billionaires sound contradictory. Mike laughs and waves goodbye, saying, play smart, invest smarter, and remember, even boredom pays compound interest eventually.